Welcome to this explainer. Imagine, just for a second, planting a tiny, unassuming seed in the dirt today. At first, it looks like absolutely nothing is happening. But you keep watering it, you give it time, and eventually, you get to watch it grow into this massive, unshakable tree. Well, investing works in a very similar way. Today, we're going to break down exactly how you can plant your own financial seed using a strategy that is simple, incredibly effective, and, best of all, totally accessible. But before we get into the nuts and bolts of the strategy itself, we've got to talk about the single biggest mental roadblock that stops everyday folks from ever planting that seed in the first place. So, part one, the big investing myth. We have to tackle a question that honestly haunts almost every single beginner. Do you really need thousands of dollars just to start investing? The answer is a massive, resounding no. But still, most people are totally convinced they need this huge pile of cash to even begin. So they wait. And they wait, trying to scrape together a giant lump sum. But here's the truth, straight from our source material. True wealth is rarely built by just dumping huge bags of money into the market all at once. Actually, it's usually built through small, really consistent investments made over a long stretch of time. So, if we don't need thousands of dollars, what exactly is the alternative? That brings us to part two. Enter the SIP. A systematic investment plan, or SIP for short, is honestly a beautifully simple method. It's literally just putting a fixed amount of money into an investment fund at regular intervals. Usually that's every single month. And that's it. That's the whole shebang. Instead of stressing yourself out over saving a massive lump sum, this automated method lets you start right now, today, with whatever small amount you have on hand. You just set it and forget it. Okay, let's dive into this with a really clear comparison to see how this actually plays out in the real world. Think of Alex. Alex is out here trying to perfectly time the market. He waits for the absolute perfect time to invest. He's constantly stressing that the market is too high or maybe too risky or thinking, hey, maybe next month will somehow be better. It is a frantic, exhausting way to live. Then you have Michael. Michael just decides to invest $200 every single month, steadily using an SIP. He completely tunes out the noise. Now, at first, the difference between Alex and Michael doesn't seem like much at all. But give it a few years, and Michael's calm, consistent contribution triggers something truly incredible. And that incredible thing brings us to our next section, where we'll unpack the specific financial mechanism that makes his patient strategy such a game changer. Section 3. The magic of compounding. That mechanism is called compounding. It's this incredibly powerful force where your money earns returns, and then, here's the kicker, those returns start earning their own returns over and over again. It's often called one of the most powerful forces in investing simply because it allows your money to grow on top of itself. It's like a snowball rolling down a hill. This brilliant concept is exactly how Michael's seemingly tiny $200 monthly contributions snowballed into serious, life-changing wealth year after year. He isn't just earning money on his original $200. He's earning money on the money his $200 already made. Okay, we've got to address the elephant in the room. What happens when the stock market gets scary? How in the world does a consistent investor handle all that inevitable volatility? Let's look at part 4, dollar cost averaging explained. Now, what's really interesting here is the math. Let's see how an SIP actually holds up during wild market swings. Let's say you're investing a fixed $200. At first, the fund's price is $10, so your 200 buys you 20 units. Pretty straightforward. But then the market drops and the price falls to $8. Time to panic, right? No way, because your fixed $200 now buys you 25 units. You are essentially getting a discount. And then when the market rises up to $20, your 200 naturally buys fewer units, just 10. This mathematically proves that a market drop to $8 is actually a fantastic thing for an SIP investor. It lets you automatically scoop up more units during a downturn, which completely flips fear-based investing on its head. When the market eventually recovers, all those extra units contribute massively to your long-term growth. This specific strategy is known as dollar cost averaging. And honestly, its absolute biggest benefit is that it removes the crazy pressure of trying to predict market movements. Think about it for a second. Most investors fail because they're constantly guessing when the market will go up or down. Even Wall Street professionals struggle to do that consistently. But with an SIP, you eliminate that stress entirely. You just keep investing regardless of what the market is doing, automatically averaging out your purchase cost over time. So if we aren't trying to magically time the market, what should we be focusing on? Well, let's shift our attention away from market behavior to the single greatest lever you actually control. Section 5. Time over timing. I want you to imagine this scenario and seriously ask yourself, which investor are you right now? Or Maybe more importantly, which one do you want to be? We're looking at two people investing the exact same monthly amount. The only difference? The first person starts at age 25 and the second person starts at age 35. They're putting in the exact same effort, month in and month out. They just started 10 years apart. And the exponential power of starting early is brilliant to see. The staggering difference in their final wealth tells the whole story. The person who got going at 25 ends up with a massive pile of wealth compared to the person who waited. Why? Because their money simply had more time to compound. It demonstrates so clearly that getting a head start is actually far more important than trying to hustle and invest larger amounts later in life. A 10-year head start creates an absolute chasm in final wealth. So, the absolutely crucial takeaway is this. The amount matters, but consistency matters even more. Someone who invests a relatively small amount every single month for 20 years is very likely to blow past someone who tries to invest much larger amounts, but just does it inconsistently. This brings us to the practical side of things. How do we actually make this happen in our real everyday lives? Well, we have to talk about the psychology of successful investors and how to build the right habits. That brings us to section 6, building the habit. Think about a number like $300 a month. I'm spotlighting this specific amount because it really shows just how non-threatening the barrier to entry truly is for everyday people. Successful investors share a very specific habit. They do not wait to see what money happens to be left over at the end of the month to invest. A lot of people do that, right? And they usually end up investing nothing. Successful investors flip the script. They invest first and then spend whatever remains. And SIP perfectly automates this exact process. You set it up for a totally accessible amount, like $300, and it just happens in the background without you needing to make a stressful daily decision. But look, we also need to manage our expectations here, which is exactly why understanding the timeline is so important. Let's walk through it. An SIP is a marathon, not a sprint. It's a long-term strategy, definitely not a get-rich-quick scheme. After 1 year of investing that $300 a month, the progress might seem a little slow. It's not going to look super dramatic, but stay patient. After 5 years, you start to notice a real difference. Hit the 10-year mark, and the impact of compounding becomes truly significant. And after 20 years, that is when people are literally blown away by how incredibly large their investment has grown. The real secret isn't finding some magic stock with extraordinary returns. The secret is pure consistency combined with time. Let's quickly summarize exactly why this approach has become one of the absolute most popular investment strategies around the world. It works for literally everyone because it's simple and automated. It's completely flexible for whatever your budget is. You don't need a PhD in finance, and you absolutely don't need a crystal ball to predict the market. All you really need is the willingness to take that first step and the discipline to keep going. At the end of the day, an SIP isn't just an investment strategy. It's the powerful habit of putting your future self first. Which leaves us with this final, really vital thought. The most important step you can take isn't agonizing over finding the perfect investment. The most important step is simply getting started. Because every single year you sit on the sidelines is one less year for that magic of compounding to work in your favor. In the world of investing, time is, without a doubt, the greatest asset you will ever own. So I have to ask, what are you waiting for? Thanks so much for joining me on this explainer. Plant that financial seed today, and I'll catch you next time.